I'm joined by Michael Hudgens, Global REIT Strategist with JP Morgan Asset Management. Issues with the European financial system, stemming largely from events in Greece, have captured considerable attention around the world. What impact have those events had on commercial property market?
With LIBOR up, risk spreads on debt up, you could see kind of a halt to the recovery in real estate values that we've seen. We've seen particularly in markets outside the U.S., but anecdotally we're seeing here as well. And obviously that would put a damper on the potential for capital appreciation for REITs as well, until cash flow starts to go positive for those properties and for the firms that manage those properties. Within Europe, obviously, some of our research has also demonstrated that total returns for private real estate investments are linked to nominal GDP, local nominal GDP, right? Making kind of private real estate a very pure play on the local economy. Well, what that means for Europe, unfortunately, is that if these events do undermine nominal GDP growth forecasts for the region, you would expect that, versus the private real estate in other, commercial real estate in other regions like Asia, APAC, and the U.S., their property markets would be underperforming.
There's evidence to suggest that there's considerable dry powder and new capital available for investment in commercial real estate. When would you expect to see this flurry of new deals that investors and market analysts seem to be anticipating?
I spoke with our own real estate group at JP Morgan who manage private real estate equity funds. And what they said they're seeing are increasing opportunities for note sales. Okay, and these are basically sales where the property is put up for sale because the property cash flow cannot cover the debt service. So it's not an issue of we need to refinance, can't get the debt. It's frankly an issue of this property is distressed. It cannot pay for its debt anymore. So that's an interesting sign. We're seeing more of those deals. And we all know, of course, that CMBS mortgages are, I think 3.5% more or less are in foreclosure. 12% are in special servicing. I would think that given what our real estate group is starting to see, the momentum builds over the second half of 2010 and it definitely into 2011.
Have you seen any meaningful change in the balance of capital dedicated to public REITs relative to that earmarked for private equity real estate fund?
A lot of these private equity funds hold good real estate, and they have not marked to market in terms of the recovery. So they have not marked into their valuations any of the recovery we think we've seen in values. They are still marked to what is a loss of about 35% unlevered. All right, so the valuations actually for those funds, the real estate held by those funds, is actually pretty compelling. Moreover, we all know that the value indices for these funds are driven by appraisals. So you have a lot of this positive serial correlation, up, down. And if investors believe that that value index is at the bottom, which I think many do as they're lining up to get into these funds, they're anticipating this, a nice smooth ride upwards. Okay, so I understand why the capital at this point is going towards private real estate. It seems to be an attractive proposition. However, what's encouraging though is that clients are increasingly asking us questions about things like liquidity and global diversification that we think will lead to more activity in the REIT space, more funds going from, or investments going from, particularly from institutions, into real estate securities. For instance, we had recently a corporate pension fund talk to us. It's, listen, Michael, the board is asking us to have more liquidity in our portfolio. We've got a lot of real estate in the U.S., but none outside the U.S., so we need to get global. So they are actually redeeming money from private equity funds to put solely, so almost 100%, into real estate securities, which is interesting.
Michael, thanks so much. That was fascinating.
Thanks for having me.
And I'm Meredith Despens with REIT.com.